Hey, my name is Rajesh. I'm a direct lender based in Los Angeles, and today we'll be looking at how to turn $207,000 into $20 million. Let's get into it. Today we'll be looking at 1377 Warren Avenue. It's an 11-unit apartment building selling for $1.629 million with a 7% cap rate. Let's get into it. Okay, so it's priced at an 8.8 GRM and a 7% cap rate. Let's see if they actually put that in dollars for us. And they do. They don't show the net operating income, but I will show you how to figure that out. And they're saying gross rental income is 186. So let's go ahead and do the math here. So the price is first we'll figure out backwards engineer this 186 number so that we can connect it to the gross rent multiplier, and then we'll connect it to the cap rate. Okay, so 1.629 million. So gross AGR, gross rent, annual gross rents is equal to price over gross rent multiplier. And so AGR is equal to 1.629 million over, what did they say? 8.7. And if you want to figure out the gross rent multiplier, it's pretty much the same thing. You just go price over 8 GR. This will give you the annual gross rents. So GRM is equal to 1.629 million over 186K. Yep. So let's see what these add up to. AGR is equal to GRM is equal to 1,629,123 divided by 8.7. We're getting 187,241 and 38 cents. We can just leave that at 187,241. And let's see if what our gross rent multiplier is if we divide it by 186. 1,629,123 divided by 186,000 is 8.75, 8.76, 0.76. So 8.7 versus 8.76. And that's because the bigger this number is, the smaller this number is. Because 8.76 is bigger than 8.70, so this number ends up being smaller than this number. Does that make sense? Cool. So let's apply that logic to the cap rate. So NOI, net operating income, this tells us what our income is after all operating expenses are, including property taxes and insurance, property management fees, maintenance, etc. So we want to know that. So it's price over cap rate. NOI is equal to 1.629 million over, and I believe this was a 7% cap rate. NOI is equal to 1,629,123 divided by 7. Oh, whoops, I did this wrong. It's times, not divided by. So price times cap rate, 1.629 M times 7%. Yeah, that's 1,629,123 times 0.07. So that means our NOI is $114,030. Now I'm going to divide that by 12 to get what it is on a monthly basis. That's 95.03, because I'm going to round it up based on that 50 cents over there. And this one, if I were to divide by 12, I would get 187,241 divided by 12. We're looking at $15,603 a month. That's our gross rents. So now we can plug this into here and figure out what loan we qualify for. But I'm telling you, based on the unit number, a DSCR loan will not work. So we're going to have to go small balance we're going to have to go with an agency small balance loan here. But we want to know what interest rate, how much down payment, etc., in order to make this loan work. So let's see, 1629, 1629, 123, 7 unit. No, this was 11 units. 0 vacancies. Gross rents are 15,603. All right, we've got property taxes, we've got landlord insurance, and here our net operating income is showing up as 93.64, and it should be 95.03 a month. So we got to add about $200 a month back here. So let's see, 95.03 minus 9364 is 139. So I got to add $139 back into this. So where can I add 139? Probably in maintenance. So 1560 minus 139, 1421. 1421. That's, no, let's see here. There we go, 95.03 for the net operating income. This box right here just does not matter. And so we're looking at, with 25% down, a net DSCR ratio of 1.35. And what I mean by a net DSCR ratio is this: net DSCR is equal to the NOI divided by P and I. Gross DSCR is equal to gross rents divided by PITI, or and that's what it is. But in order to qualify for a loan, we need the gross rents to qualify. Let's see here, maybe a new sheet right there. No. Yeah. To qualify for a DSCR loan, gross rents have to equal PITI, and for a bank loan or an agency loan, gross rents, or rather NOI, has to equal to P&I times 1.15. And in this case, let's see here. Let me actually put this better. Greater than or equal to, greater than or equal to. And in this case, NOI is 1.315 times greater than P&I. For this particular building, NOI is equal to P&I times 1.319, or yeah, 315, sorry, 315. So the 1.315 is greater than 1.15, so this building qualifies for the lowest down payment, which is 25%. So that means you're going to have to put a down payment of roughly $407,250, and your cash flow is going to be $2,200 a month. But that's at this interest rate. Let's see what the actual interest rate will be. And the way we calculate our interest rate on this product is we look at the 5-year CMT today, and today it's at 3.85%. So we go 3.85 plus 2.25, which is equal to 3.85 plus 2.25, 6.1. And if you compare this to my older videos, you'll see that interest rates are actually going up. So we had to punch in 6.1 here, and that might affect the down payment. It did not, but it did affect the net DSCR ratio. Fortunately, that DSCR ratio did not fall below 1.15, meaning your down payment still stays at the minimum 25%, but now your cash flow went down from $2,100 to $2,145 to $2,099, or about $46 a month. But now that we have this information, we can plug it in here and start underwriting it like an investor. This is for underwriting it as a loan officer, seeing if the loan qualifies or what the minimum down payment would be. But here is where we put our investor hat on. And with this, we'll be able to see how much money, what kind of exit we'll have on this property in about 30 years. And why 30 years? Because I'm a long-term investor. I like this saying that millionaires sell, billionaires hold. And for me, I sort of base my investing strategy around that. If that's not the way you do things, that's cool. I'd love to hear your perspective in the comments. So you can see that I've previously analyzed properties in Long Beach. For example, I last did this building in on Linden Avenue, 90802. This one is 90813. Let's copy that link there. And so economic factors are pretty much going to stay the same because it is Long Beach and it's hard to find economic data, long-term economic data specific to zip codes, although I think that would be a great tool. If somebody's out there willing to do it, please do it. You'd make a lot of money doing so. Maybe I ought to do it. But here's what yearly appreciation is for Long Beach. Generally speaking, 8%. Rental inflation for that area is generally 4%. And vacancies we're going to consider at 8%. But to match it up to this tool here, I'm going to put 0. Property management was at 8%. Interest rate was at 6.1%. And we're putting 25% down, assuming closing costs of 3.5%. And we're not spending anything on rehab here. By the way, if you do want to figure out how to find yearly appreciation and rental inflation, all I do is I go to Google and then I type in the zip code 90813. Yearly, or rather average yearly appreciation rates past 30 years from 1996 to 2026. So why 1996 to 2026? Because it's the closest to this year. It doesn't make sense to look up 30-year data from 1950 to 1980. It's not close enough to today's period to really matter. So we need to look up from today going back 30 years. So going back 30 years from today would be 1996. So based on this, Los Angeles County is between 5.3% to 8.6%, and they don't show for that specific zip code. For this one, they go break this down year by or decade by decade, but they don't, not even decade by decade, it's like 10, 4, 1. Los Angeles County is 5.3. So we're looking for this specific area. What we can do is say Long Beach in general. But while year-over-year growth fluctuates, the long-term trend in the Los Angeles, Long Beach area has shown a high average, with data indicating roughly 8.6 per year. Neighborhood Scout, over the last 10 years, Long Beach has experienced a cumulative appreciation over 96%, averaging roughly 6.97. That's past 10 years. I'm interested in 30 years because there are busts and booms, and sometimes if you have one depression or one recession every 10 years or every 5 years, that doesn't also take into account the booms that happen. So you need a bigger time frame to take that into account. So I'm going to leave it at 8% because it's not as high as 8.6, which is what they're showing here. So let's see here. Now what I'm going to do is rental inflation rates. Rental inflation rates. Often exceeding 3% to over 5%. Average trend, 3 to 5% in the 2020s. Only 0.84% in the past year. Annual inflation rate is 8%. Oh, this is the maximum allowable there. So this is between 3 to 4% in the year in the following years. That means from after 2010. Long-term trends show over 3% and sometimes over 5%. So I'm just going to leave it at a 4% over here. After repair value, projected ARV price, we're not making any improvements to this building. We're just leaving it at 1.629 million. And here we have 11 units. 11 unit apartment building with gross rents of $186,000. So we're going to use 186,000 divided by 11. 186 divided by 12 divided by 11. What's going on with this calculator? 186,000 divided by 12. That gives me my monthly rent. Now divide that by 11. That should give me $1,409 a month. We're going to put 0 other income over there. And now hazard insurance. So we're going to punch in these numbers to add up here. So since this is an 11 unit building, I'm pricing it at 11 times 1100 per unit per year. So that's 12,100. And that should give us 108 if we divide that by 12. 1,008. Yep. So let's see what our legal fees are. We're saying legal is $120 a month. And that doesn't mean you're spending $120 a month on legal. It means you're creating a separate bank account called legal, and every month from your gross rents you're taking $120 and putting it into that bank account, that separate bank account. Gas is at 20. Same gas, you are paying water bill directly to the utility company, SoCal Natural Gas. Let's see, electric would be 80. And let's see what it is for water. Water is 65. Lawn and snow is going to be included in the maintenance. HOA trash removal is $250. Pest control is $180. Advertising is $10. And maintenance I have at 0, but here I have at 1422. So as a percentage, if I were to do this, 1422 divided by 15603, I get 9.1%. So let's see here, 9.1, and there we go. So now our operating income is $114,341. What did we say NOI was here? $114,030. So this is a little bit high. What I'm going to do is calculate some vacancies into here. So let's see if I go 1% vacancy. That drops it by almost $2,000. We're down to $112,000 just at a 1% vacancy. So we got to subtract $200. So let's say we are, now let's say 0 for gas. No, we got to add 200. Let's say we're at 40 for gas. That's still too lawn and snow. I can add that in here now. 100. No. Let's say 50. No. 25. There we go. So we're going to put 25. And this is just to balance out the numbers and come close to this figure here, so that when we start analyzing this like an investor, we can sort of create tolerances, you know, like best case scenario, probable case, and best case. In this case, we're going to anticipate an 8% vacancy, and that's going to drop our NOI down to 101. So now we went from 114,000 NOI to 101,000. So we lost 13,000 in a year of net operating income just by anticipating an 8% vacancy. And we do that so that we can say, hey, if we do have an 8% vacancy, can we still make money? Or are we only making money in the best case scenario? If you're only making money in the best case scenario, it is a bad deal. Not this, but it is a bad deal. You want to make money even when it's the worst case scenario. At least I want to make money even when it's the worst case scenario. So I want to protect my downside and get a good upside. In this particular case, we're with that 8% vacancy, we're looking at a cash flow of almost $13,000 a year. If we stick with the 0% vacancy, our net cash flow is $25,000 a year. So a well-managed building will get you a lot more money. Let's see what happens when we're at 15% vacancy, what our net cash flow is. We are at $2,000 a month. So that's tight, or sorry, a year. $2,000 a year. So that's a little over $150 a month. Let me see here, 2069.05 divided by 12. Oh, a little under $200 a month. You're making $172 a month. So I'm going to leave that at an 8% vacancy because that's generally the industry average. And let's see what happens with our net income. Net income means that you're taking your cash flow and you're writing off your mortgage interest, you're writing off your building depreciation, and you show a loss on here so that you don't have to pay taxes on it. But I do want to call attention to the cash flow again. So after 30 years, let's say you take all that cash flow, you put it under your mattress, it's not collecting interest, and you're not touching a single dollar from there. After 30 years, you're going to be left with $1.7 million, which is quite impressive considering compared to some of the other buildings we've evaluated on this channel. Net income, you get to write off. You're not paying taxes on any income for the first 10 years. On your 20th year, you're going to have to pay taxes on $35,000. Of course, in 20 years, that $35,000 is probably going to be worth the equivalent of $3,500 today, given inflation. 30th year, you're going to have to pay taxes on $75,000, which is probably going to be the equivalent of $7,500 today, given inflation. Now let's look at the exit strategy. At what point, let's say you buy the building today and you decide to sell it after a year, are you going to walk away with a profit? And no, you're going to lose $216,000 in that transaction. Do it on your second year, you're going to lose $159,000 on that transaction. But if you sell it in year 5, you walk away with an $82,000 profit. Is that worth it? No. So, but if you hold it for 30 years and you sell it after 30 years and you add back all that cash flow that you've saved under your mattress, you walk away with $13.25 million, $13.26 million. That's a 2,600% return on your original cash investment, or a 27x on your cash. So you initially put in $407,000, and for that $407,000 you get to walk away with $13.25 million. Now that's if you want to leave your money in the building. If you want to pull that money back out so that you've essentially got a building for free, here's the formula to do that. This is when to figure out when to do that cash out refi. So you do down payment plus purchase price has to be equal to 75%, because you're allowed a maximum 75%. Well, let's say 70%. Yeah, let's say 75% of the total. Let's see here. 75%. Best time to refi. To cash out refi. Okay, so let's go ahead and see what that is. Down payment was $407,500 or $250, I believe. $407,250. Purchase price was $1,629. So we're seeing that's $2,036,000. 1,629. 75%. 2,036. 250 over 75% is equal to 2,036,250 divided by 0.75. So when the building is worth $2.715 million, that's when you should refi. And over here you can see that happens somewhere between year 5 and year 10. So we can guess year 7.5, because it seems property value when you buy it is $1.629 million, and assuming this yearly appreciation, on average you're going to have some years that are higher, some years that are lower, but this is based on averages. So year 1 it's $1.629 million, after a year it's 1.759, after 2 years it's 1.9, after 5 years you're at $2.4 million, and you need it to be worth $2.7 million before you can before you can do the refi and pull your original cash investment out. So between years 5 and 10, right? And you're going to leave about 70, you're going to leave 25% of the new equity in there. So you're going to go 2715, 123. Assuming interest rates stay the same, you can leave that there. You can update this 2715, 123. And you're going to take interest rates from here. So the way I'm going to do this, actually let me update this right here. Yeah, so what I'm going to do is actually find the average of these two numbers. Average is 2.95. So 295. So if we do the cash out refi on year 7.5, we're going to have a value of 2.955 million, roughly 2955 212.13. And so that will allow me to also punch in the numbers for the costs in those years, because it's not just about doing the cash out refi and the operating expenses stay the same. We also have to take into account the fact that costs are going to go up. So let's use this number instead, 2955, 212.13. We're staying at 25%. Let me copy and paste this number here. And let's see here, what's the average on this? That's 1826.89. 1826.89. What's the average here? 14982.52. 14982.52. Average on this 148.59. 297.17. 297.17. 965.82. 965.82. 1188.70. 1188.70. 371.41. Oh, I got to divide that one by 12. I believe. What's going on here? Something's wrong. Oh, these are based on okay, so that one looks like it's based on a yearly basis. Is it? Yeah, so I'm not doing that by 12. Okay. So we're going to do the average here and then divide by 12. 297.17. 7.17 divided by 12. 24.76. 24.76. 965.82. 965.82 divided by 12. That's 80.49. 80.49. 1188.70. 1188.70 divided by 12. 9906. 371.47. 371.47 divided by 12 is 30.96. 30.96. Here we're at 3714, 3714.67 divided by 12. We're at 309.56. $2674.56 divided by 12. 222.88. And then advertising would be 148.59. 8.59 divided by 12 is 1238. Okay, so let's see if these numbers still make sense. So now we're losing cash flow for 10 years. We're able to write off the income for every single year that we own the building after the refinance. And exit wise, after that 10 years, so a 40-year exit, we're looking at actually a $20 million exit, $20.38 million. So we hang on for 10 years after pulling out that cat, or rather we 7.5 years plus 30 years, so 37.5 years. So 37.5 years, we hang on 7.5 years additionally after pulling out our cash. We're walking away with 20.38 million, but you also got to factor in that you're losing cash for an additional 20 years. So if you were to add up the total losses in cash flow for those 20 years, then would they still add up? Well, my guess is that they would add up to more than the original 400,000 that you had put in. So in my mind, it's better to just leave that $407,000 in there, and then after 30 years you're walking away with 13.2 million, because for an additional 7.5 years, well, maybe not. Let's see what happens. Here your cash on cash return is 26.34, or 2600%, or 27x, whereas if we do all this, we're walking away with a 23x return on money on original investment. But we're also looking at these losses, whereas over here you have, when you do this, you got to add up all this money right here. So let's see what this could be. What's an easy way to do this math here, because we had to do that for 20 years. Seems like it's decreasing. The losses are decreasing at about 4,000 a year. So maybe 11 years actually. Yeah, maybe 11 years. So let's see what that looks like realistically. We're going 38,688 plus 34,823 plus maybe 30,000, then 26,000 plus 23,000 plus, what's 23 minus 4? 19,000 minus 4 is 15,000 plus 11,000 plus 7,000 plus let's see here, 11,000 minus, or 7,000 minus plus 3,000. So that's 207,000 right there over 11 years, over 10 years. So year 11 is when you recover that. So now we take that 211,000 minus your original $400,000 investment. What was the original down payment here? 407,250. So minus 407,250. So for $200,000, you can walk away with $20 million. It just takes you 37.5 years to do. And that is, let's see, whoops. Yeah. So let's see, 207,511, I believe it was. And we're going to figure out the CAGR here. Okay, so 23,81480.88 divided by 207,511. We're looking at a 98x return on your money, or a 9,800% return on your money, which is astounding actually. So let's see here. This number divided by 207,511 as a percentage. Yeah, 9,800% return on your money. Now let's do here as CAGR formula over 37.5 years. So you're looking at a 13.01% return on your money every single year. Again, that's not bad. That's pretty good. And you own a building. Now, if you own 10 buildings like that, you're a billionaire.